had a down day on Friday, but an up week. And so that was good news, even though we ended on kind of a downer as the Democrats and Republicans have hit an impasse.
Well, and the NASDAQ, for the first time in 18 months, made a new all-time high this week. Small cap stocks bounced as well. And, you know, in light of all of the negativity concerning the recessionary fears and inflation and the like, the market has really been resilient.
And you talk about, you know, we're talking about NASDAQ stocks, and really the big S&P 500 companies really are determinant of where we are, up over 8% for the year. But you take those big names out, and it's a different story.
Right. If you take out the companies that are most directly affected by artificial intelligence, the S&P 500 is down 2% for the year. And this is, you know, Dave, you often say I'm a reformed mutual fund manager. But when you think about it, the retail investor has an advantage. If you're a mutual fund manager and you don't own those big stocks, those big large cap growth stocks, and you're a growth manager, you're going to get fired.
And you think about, you know, where we have been with quantitative easing and all that free money, and now we have quantitative tightening, and really what that is. I know we've talked about that a lot, but the Federal Reserve has a balance sheet, and now we're building up this balance sheet to more than $9 trillion, and now they're letting that balance sheet roll off. In other words, as these bonds come due, they're just not renewing those. So that is really kind of a tightening process at the same time. But the reason why I bring it up is because all of this free money has come to an end.
Right, and the thing with this debt ceiling is adding a new wrinkle to that. Because the Treasury is not able to issue Treasury securities and raise capital, they're having to spend down their cash account, and that is injecting liquidity, which for the most part right now is offsetting what the Fed is trying to do. That will change once the debt ceiling deal is passed.
You know, we talk a lot about what the Fed was doing, of course, and that they were buying mortgage-backed securities. You know, about 2/3 were Treasuries and about 1/3 were mortgage-backed securities. And that is going to be an issue, of course, because people need to refinance for those to be a market in that space as well. And so I think that could be an issue down the road.
Oh, absolutely. I mean, I saw today that mortgage payments on the median home hit an all-time high today of $2,566 a month. So houses are not affordable. There's a lack of inventory. Many people are handcuffed because they've got great mortgage rates and they don't want to move unless they can do a cash deal, of course. So younger folks who are trying to, you know, buy their first home are having a very difficult time.
You know, Danny, you talked about cash is not trash. That is really the story. And we all remember the banking crisis that kind of brewed up about a month ago. And, you know, it really wasn't, you know, the old days of a bank run, because of the fact that people could sit on their phones. And that's really what happened with Silicon Valley Bank. $42 billion came out in 24 hours, and nobody stood in line at the bank. They did it over the phone. What we're seeing now, Derek, is a bank walk, I like to say, because people are taking their money out and finding higher interest rates other places.
Right. I mean, when you think about it, the long-term expectation for the S&P is about 9% per year. Well, a 6-month T-bill yields about 5%. So you take no risk, and you earn 2/3 of the return you'd get on the S&P 500. And perhaps when the dust settles, and maybe after we have a recession or when we're in the midst of one, then you reload, you sell that T-bill, and you go in and buy stocks on sale.
Now, we're not trying to tell you that you should time the market, but there certainly is the days of just buying the S&P 500 exchange-traded fund and setting it and forgetting it are really kind of moving away from us, and you're really going to have to start doing some work if you're doing this on your own, or if your advisor has just put it in a set it and forget it portfolio. We do think the thesis has changed.
Right. I mean, one of the key cogs in our team, Jason Cooper, does a fabulous job listening to conference calls, digging in on the details, doing credit analysis, trying to figure out whether companies that don't make money will survive, or those that do will have the free cash flow in order to build their operations, do M&A, and grow in the future.
So that is the reason why we talk about this, folks. And when we say the thesis has changed, it really means you need to go through that portfolio, and you should understand what you own, why you own it, and how much you're paying for it. And these are really important times to go through this. We do think we're going to have a bumpy week and a bumpy quarter, especially as this debt ceiling debacle begins to heat up.